Hi, I'm James Dunn. Welcome to the Inside Network. Joining me today to discuss private equity secondaries is Jack Wasserman, Managing Director at Pantheon. Jack, welcome.
Thank you very much. Great to be down here in Australia.
It's a great pleasure to have you here. Jack, Pantheon was a pioneer in the Evergreen space. First of all, take us through what that term really means, and then what's your perspective on the growth of Evergreen vehicles as an access point for investors in the wealth channel?
Yeah, I think you've hit the nail on the head with the word there. It's around access. And so we've seen a huge growth in these vehicles, and just sort of unpacking what Evergreen means. It is giving people often monthly subscriptions, sometimes quarterly, but often monthly subscriptions into private assets vehicles. And so we at Pantheon have been running different forms of Evergreen capital for 40 years, but in the newest version, open-ended Evergreen, i.e. the ability to subscribe and redeem, we've been doing it for over 10 years. And so I think clients, and specifically the wealth community, who have been starved from access to private assets in general, but private equity specifically, are seeing a real opportunity for them to diversify their traditionally public portfolio to get into private equity, private credit, and private infrastructure.
A core differentiator for Pantheon is your focus on the small to mid-cap buyout space. Why does that offer a better risk-reward profile in Pantheon's view than the other sectors of private equity?
Yeah, I think it's a great question, something which over the last 40 years of investing in private equity, we've continued to see sort of structural outperformance from small and mid-cap. And so what we're trying to deliver investors is a single access point to mid-market private equity. And so the reason we like that is because you get cheaper valuations, often 2, 3, sometimes 4 turns lower multiples entering these companies, so you're buying them cheaper. That's great. The second is that there's less risk around the leverage. So they are typically will be 4 or 5 times levered versus 6, 7 times levered in the large cap space. And those two factors just give you a buffer around both your entry and then the risk management. The other reason, and the final reason on mid cap specifically, is the optionality for exits. We've been talking a lot over the last few years around exit dynamics and how that's come down and come off. That's certainly true in the large cap. It is also true in mid cap, but that's not our only exit route as in IPOs. We will also sell to large cap private equity, so selling to sponsors, or we'll sell to strategics. Typically, both of those buying entities, they want to buy into growth. So if you're a strategic and you're making an acquisition, you want to then buy in growth, and so often we'll get a premium return for that. What's really interesting when you think about our portfolio over 2025, we saw consistent small dollar amounts, but consistent exits, often at a premium to the previous NAV. And so it's been great because we intuitively know there's value in the portfolio. It was nice over 2025 to see that being evidenced and tangibly coming through. And those premiums were anywhere from 15 to 25% above the prevailing NAV. And so they're the sort of valuations, leverage, and exit optionality is why we want to give investors access to mid-market.
Jack, the secondaries market has been growing meaningfully in recent years, but you could almost use the term exploded in 2025, plus 50% growth in the market. What has Pantheon observed from that growth, and how are you navigating this period? Is it something that be careful of what you wish for?
Yeah, completely. I think it's, as we do with all market environments, it's proceed with caution and proceed with discipline. And so the way we think about the growth in secondaries, and this is true for private equity, for private credit and infrastructure, is broadly that's great because we see those sellers, and maybe unpack the different types of secondaries we've got. You have LP-leds, where it'll be a pension plan or sovereign wealth fund who's got a private markets portfolio. They will require liquidity. And so we will buy that off of them and then take on the private markets allocation. We're also seeing a growth in the GP-led, where we have a single manager who's looking to hold on to a trophy asset and see the next growth of that company. And so we've been active in both. when we think about the growth of the market more broadly, some of our peers have raised incredibly large funds, and that has put pressure on summer pricing. And so we are really conscious about the price you pay when you move into these transactions. And so as we look back and also look forward into deal flow, we're trying to go back to our first principles. What do we as Pantheon offer as a edge? And that is typically small to mid cap, which is what we've spoken about. And it's working with who we consider to be the best GPs, the fund managers within private equity, the best fund managers within private equity in their specialism. And so even with all the secondary deal flow and the explosion, as you rightly say, we are still proceeding with caution. The price you pay is going to help drive the performance you get.
So that change in the market, Jack, that massive surge in GP-led transactions, when the market had been primarily driven for a long time by LP-led transactions, is that something that means having really deep GP relationships could bring you to the fore in that change in the market?
Yeah, James, I mean, completely. And so 10 years ago, GP-leds was a bit of a dirty word. It was private equity fund managers trying to get rid of some of the assets, and that's completely changed. People now see it, and our fund managers, who you rightly say, we've got incredibly close relationships with the managers that we work with. Those fund managers, they know their assets better than anyone else. And so these GP-leds, or continuation vehicles as they're called, is really the carve out of a trophy asset that they've already delivered the first leg of growth. And so actually these management teams and these private equity managers want to keep hold of that asset and deliver the next leg of growth. And quite often from a Pantheon point of view, we'll have exposure to that single company because we've invested in that manager's fund. On the primary side, that means that we invest whenever they're in market looking for new capital. We might have invested in that deal when they do a co-investment, i.e. invest alongside them when the deal gets struck. And now we're doing GP-leds, i.e. investing when they want to deliver the next leg of growth for that vehicle. So you're absolutely right. It's a big part of the deals we do, but we would call them alpha deals. It's sort of single asset, not always, but often single asset, high conviction deals.
Given that very wide breadth of underlying GPs with which Pantheon works, how do you see investors using evergreen private equity vehicles within the context of their broader portfolios?
Absolutely, and I think it's a really important point because we're seeing more options for the wealth community to get access to private equity, and so understanding the different tools available to them I think is important. Broadly, we're seeing two different types of evergreen products. And so one is the large cap single manager name, typically US large cap buyout, or then you're seeing the multi GP, someone like a Pantheon, where we're investing in a number of underlying who we consider best in class private equity managers. And we think they play different roles within a portfolio. Pantheon, we're looking to deliver a core diversified allocation to mid-market private equity. We do that through secondaries, as we discussed, both LP-led and GP-led, and we do that through direct co-investments. And so that, within Pantheon, we'll be looking to deliver north of 1,000 companies within our portfolio. We see those multi-GP evergreen funds as a core allocation to clients' portfolios, and then they will build high conviction satellites around maybe a sector or geography best in class manager. And so that's the way that Australian investors, for example, have been using the Pantheon products.
And Jack, just in that context of primary vis-a-vis secondary in private equity, can you make the argument for advisors in the wealth channel that secondaries is actually a better and more efficient way for them to get that exposure?
I think I would say, and we at Pantheon would say, it's a different way of getting that exposure. We're looking to double down on the best in class mid-market managers, and we do that through those three different vehicles. So what we mean when we say primary is we are looking to allocate to the funds that the private equity managers are raising. What we mean when we say secondaries is we're looking to buy exposures in those funds that have often already been held for 5 years' time or so. And then co-investments where we will do deals alongside the managers. They've also each got different return profiles and characteristics. So primaries will often have a J-curve. They will often then deliver really strong compounding and performance over time, but you've got to manage that J-curve. They are locked up, so you're locked into the vehicle from 10 to 12 years. On the secondary side, you're able to invest in a visible portfolio. You know what the underlying looks like. You can price that appropriately. But to your point, you then get a shorter duration. So liquidity comes back to you earlier. That's really powerful when you think about an evergreen structure. And so I wouldn't say better, I would say understanding the drivers of each access route,
Yes.
and then understanding what structure they're in. And we've seen this in the market, a number of managers who are fantastic investors, but being fantastic investors doesn't always translate to being fantastic managers of evergreen funds. And so understanding how you build portfolios, secondaries is an element, so are co-investments for compounding, even seeded primaries, where you can get some of that really strong compounding, some immediate markups because you know where the portfolio's at. It's about portfolio construction and what access route or what structure you're delivering that to your investors. We at Pantheon, we do a huge amount of primary capital investing, and we do a huge amount of secondary deals as well as co-investments, different proportions in different structures.
Jack Wasserman, Managing Director at Pantheon, all the way from London. Thank you very much for your time.
Thank you very much, James.